And click right here. Hello, everybody. Welcome.
Hello, how are you?
I'm good. Did you guys all get a chance to review what Manny taught last week? Like sorting out the rent rolls and everything?
Yeah, matter of
That
fact,
was good.
I was just going over it.
Oh, okay.
It's coming along. I guess I listened to it maybe 20, 30 more times than I have it. I'm just kidding. Maybe one more time I have it. I almost got it.
However number of times it takes, James, to get it.
You said do it a number of times it takes.
I said whatever it takes, right?
Yeah. Right. Yeah, gotta do it, man. Gotta do it.
Cool, Dave. Have you had a chance to play with it?
No, I did not, but I know that I need to do it. No, I did not
Okay.
get a chance yet.
Okay, cool. Cool. How's everybody doing with underwriting? Does anybody has like a deal or property they're underwriting that they'd like for us to take a look at, take a stab at, and that need any feedback?
Yeah, I'm doing one, man. I think I might have mentioned to you before, a 5-unit in Tacoma Park.
Okay.
I don't know why I mentioned that to you or not. Matter of fact, I think I'm gonna put an LOI on it probably next week. I think it looks pretty good to me. It looks pretty
Okay.
good to me. Some of the matrix is a little off. As example, the cash on cash is low, but the return is like 19%, but the cash on cash is like 6% or something like that. 5 units rather. 5 units. He's asking a million. It's in Tacoma Park, like I said. He asking $1 million. I'm looking at. I've been telling him it's worth only around 880, but actually, it's worth a little bit more than 880. But I'm gonna offer 880. But I can send you the document. I can send you how I wrote it up later if you want to. I might be able to pull it up here if you want to look at it.
Okay.
But I didn't use yours because it's only 5 units.
Yeah, it will probably won't work. Yeah, it probably won't work for the whatever the SDA. So that would not be an ideal spreadsheet to use for that. Anyway, so I'm just gonna go into a deal that we looked at recently. And probably got outbid on it or something. We've been looking at a bunch of deals lately, and it's been crazy. Losing on all of them.
Mm-hmm.
Where's the deals been at?
So we've been anywhere from North Carolina all the way down to Florida. We've had deals in Alabama, South Carolina, North Carolina, Georgia, and we've been best and final on a couple of deals in Charleston, on a few deals in South Carolina, and on a couple of deals in Georgia. But at the last minute, somebody always comes and offers $2 million more than what we could pay for it.
Yeah, that's what I've been hearing. So they're saying $1 million or $2 million more than what people are offering. So
Yeah. So let's take a look at this deal here in was it in Atlanta? What was this deal? That was in September. We're gonna take a look at a deal that we recently underwrote in Atlanta. Please mute yourself so that we don't have too much background noise. Retreat at Baywood. All right. I'm gonna pulling up this property here shortly. I actually flew down to Atlanta to visit this property. And we tried really hard to win this one, but it was more than we could handle. There are too many big pockets out there. So this property is called Retreat at Baywood. It's in Atlanta. I think it's in South Atlanta. Mostly like in the industrial. This area in Atlanta is not as fast growing as the others, but recently there's been a spike of growth in that area as well. So this was kind of like a unique opportunity. The property used to be, it was built as a low-income property, like a low-income subsidized housing. And over the last couple of years, that period of time where it had to stay low income kind of phased out. So the owner had been moving it to market rate. By the time we visited the property, there were just about two of those, I think about 4 of those tenants that were still on the low income program. And we had the new buyer had the right to move those tenants over to market when their lease expired. So it presented a great amount of opportunity. It was a total of how many units was this again? 48 plus 70. I think it's 120 units, all 2 and 3 bedrooms. Very spacious apartments. Nicely built in 1995. Total 120 units. And the owner had done some renovation on a few of those units, but not many. And there were a lot of classic units on there that you could go back in and do more renovations on there. One other thing about the property is there was a lot of green space around on the 120 unit. There was a lot of green space in this complex that you could add a few amenities on there and really make the property more competitive in the submarket. As you can see, it says renovated rent comparables are like $400 above in place effective rent. Obviously, this is a little bit on the high side, but there was a significant delta between where this property was renting and some of the renovated properties in that area. So there was definitely some opportunity here. The ownership had renovated 25 units, and they were achieving an average of about $227 per unit for the classic and partially renovated units. So and there's another property in this not far away from here that had undergone significant renovations, and the rent delta was significantly higher than where this property was at. Again, situated in the heart of an industrial submarket that is growing significantly, great amount of rent growth in this area. Just fueled by Clayton County growth and whatever else is happening in Atlanta. As a matter of fact, when we were there visiting the property, we found out that there's a road that passes right in front of the property. That road was getting expanded to add more lanes. So the project had just gotten approved. That's usually a good sign for any property. It means that there's a lot of growth happening in that area. So I'm sure whoever got this property is going to end up doing good over time, but we have to stick to the numbers. So that's why we missed out on this one. Projected rent growth in the area by Axiometrics is like 6.4% annually over the next 5 years. This number is probably real, but it is very, very risky to underwrite based on that number at a 6.4% rent growth over your period of time. Because if you do that, it's going to project your return significantly higher. And any kind of changes in the market that are unforeseen and this number drops down is going to significantly affect your return. So it's usually better to be aggressive when you're projecting rents over the first couple of years, because based on what is happening right now, a lot of economists can accurately see over the next 12 months, except COVID happens again, or over the next 24 months, or unless you have like a black swan event like what we recently had. So so if you want to be aggressive on the rent growth, I'll say not go past the first couple of years, because after that, in my opinion, it's just being a little bit too speculative. So unless it's like a really, really solid market that you know, that like Austin, Texas, for example, or Dallas, or maybe like Washington, D.C. or something like that. But even with that 6.4% over 5 years is it's a little bit nerve-wracking for me. So the property is right here. There's a lot of development happening in the area. It's not too far from I-75, and it really is not far from I-75. And there's a lot of good things happening in the area as well. I think we drove to Starbucks that was about 1.5 miles away from this property. So it's a really nice area. It's up and coming. There's a lot of growth happening there. Just some more graphs about it. And this is what the classic units look like. When we went over there, there were just 2 vacancies on the property, even though they had been going up on the rent organically about $100 prior to us visiting. So but it was still almost full. So that means that the rent is actually below market. This is what some of the partially renovated units look like. And this is what the full upgraded renovated units look like. So the value add was to renovate most of the units up onto this level and be able to capture that delta in market rent. And visiting the properties, these upgraded units, they actually look nice. They actually look really nice. I thought that it was nicely done, and continuing on that package definitely would have attracted some good tenants. They also talked about a washer dryer program with a $45 rental every month. So, which is also a possibility because every single one of these units has a washer dryer connection. And the building had like it has a freestanding community center, which is towards the back of the building. And there's a lot of green space behind this community center as well. One of the things we talked about doing right here was to, there's a gym in here, and there's this big space, this entertainment space is right there. Nobody really uses it. One of the things we talked about was doing maybe like office space, like a live, work, play kind of area where residents could come in and do some office work and stuff like that. And behind this building, there's a lot of green space that we talked about maybe doing a dog park over there as well. Because having that dog park and it was an old basketball court that is covered with a lot of leaves. It's not necessarily the best area for a basketball court, but you could turn it into a dog park easily for low cost and be able to capture that extra income in pet fees. As you can see, there's a lot of space. There's a playground space here. There was another playground space down there somewhere. This is the leasing office. Right at the entrance of the building. A lot of green space where you could expand it. Maybe they talked about creating like a big dog park right here in the center, but we didn't think this space right here in the center of the building was ideal for a dog park. There was more space in the back that was better. So again, a lot of green space in the building. So there was a lot of space. The brokers were proposing that you do like a high amenity upgrade, which included building a new pool and adding all this extra amenities outside, because there's a comp for this property that is right down the street that has a pool, and that one was renting about $400 above this one. So that was a comp that they were using and saying you got to build a pool and do all this stuff. But when we went down to the property and spoke to our property manager, who was very, very familiar with this property, and we developed a business plan, he didn't think we needed to spend that money for a pool and the outdoor area. He was very familiar with the area as well and everything that was happening in the area. So our plan was not to spend all that money to build this exterior pool, just do the dog park, do some landscape cleaning up, maybe add like a nicer grill area, then do the interior upgrades. And there was definitely space for an Amazon locker as well in that freestanding community center, which was something we considered doing as well. Again, all these added amenities just make the place nicer, and it encourages, it kind of takes up, like steps up the level of the apartment a little bit and encourages more high quality tenants who want to live in there. So so that was pretty much a business plan to kind of spruce the place up a little bit, do some interior renovations, and then capture the rent growth in that market. So again, it's the retreat at Baywood. It's in Clayton County in Atlanta. Everywhere in Atlanta, there are jobs. Atlanta is growing significantly. I was just reading a report from PwC on our projections for 2022 for the real estate market. And Atlanta was there in the top 10 markets again in the country. And that has been the trend for the past 10 years. And it looks like Atlanta is not slowing down. And if you live in Atlanta or you go around Atlanta, you will see what's happening. So if you're there, find a property, buy it. And this is their pro forma for whatever the property, what they were projecting. I'm not going to spend any time looking too much into that pro forma. I'm going to click through this really quickly, then I'll go into our underwriting for the property and review it. But before I start going there, if anybody has any questions, please feel free to ask while I pull up the underwriting. These are just some sale comps for everything that was selling in that area. As you can see, the price per unit. So.
Hey, Leslie, this is Linda.
Yeah.
Quick question. I know at some point Clayton County schools had lost their accreditation, and then they had worked to get it back. So I was wondering if the broker had shared any insight with you on how that process was going, because generally when you get it back, it's some type of a trial to make sure that you can maintain it. Did they talk to you at all about that in Clayton County?
No, they didn't talk to us about at all about that. And everybody we spoke to, nobody seemed worried about any school situation or anything like that. The property, there were a lot of people in the property that have kids that go to school. So, and the property manager didn't seem worried about that as well. So I wasn't aware of that. So that's not something that we really inquired on. So
Okay.
but that's a good point. Maybe I should have spoken to you first before going down there, Linda.
When did you go?
Oh, what was this? This was about a month ago. It was like one of those quick trips where you leave, you go on a Monday morning, then come back on Monday night.
Oh, okay. Gotcha.
Yeah. And then you have a best and final interview call, and the seller says, "Oh, I like you guys, but somebody gave $2 million more."
Mm.
So
Okay.
that's kind of what happened. So I'm gonna pull up on the writing here.
They didn't like you that much, huh?
Nah. The money talks, brother. Money talks. So yeah, it's interesting what's happening in the market right now. But even with that, every experienced person you talk to, people that have been in the real estate market for, I'm not talking about people that have been in the last 10 years when everything has been all ships rising, like people that were there before that have had to do with a bunch of a few crises. The unanimous thing I hear is buy more. Like buy more. And I was reading a report, another report, it's called the Lineman letters. And Dr. Linneman is like a professor of economics for one of those Ivy League schools, and he does a lot of writing on real estate. And in his report, he kind of outlined the graphs of like the performance of multifamily assets all over the US. And when you look at multifamily properties over 3 years, right? I think there's like a 30% rate of properties that lose money or that fail in the business plan over a 3-year period, like a 3-year business plan. When you start going to 5 years, that number decreases significantly. And when you look at a 10-year span, zero lost money. That is like zero based on the data that he presented. So interesting to know that with this asset classes in strong markets, you could weather the storm if you go in like those period of time. Anyway, and enough on the data stuff. So this property, as Manny taught you guys, it starts with sorting out the rent roll, and was nicely done here by Manny himself. You see everything is sorted out and categorized properly. The T12 as well. I'm sure Manny is gonna be going over how he does this as well. It's the same thing where he categorized everything, and everything comes up to the input tab right here, where you have your calculated market rent over 12 months over T12 and the T3. I want you guys to see what's happening here between the T12 and the T3. So the property, the market rent is increasing significantly over time. So this is good because as the rent, right now, a lot of properties you would see this like, you want to see a significant difference in the T12 and the T3 because that means that that market is going up. And with that, you're going to see a higher loss to lease over the T3 period, which means that you have some catching up to do on the rents that are not up to market rents. So when the leases start expiring, you should be able to get most of them to the new market rate because rents are increasing now significantly. But you see the vacancy here is slightly higher. So that could also mean that the rents are going up and people are not wanting to stay over there. But when we visited this property, there were just 2 vacant units. So that's another thing that when you look at these numbers and you go and visit the property, my experience has been all the properties that we've actually gone to tour for like a pre-due diligence, the story is actually much better than what I see in the paper on the underwriting. We haven't had that experience where we have on the road a property, then go to look at it and it's worse than what we see. I guess that's because our underwriting is kind of very conservative, so that's helpful to avoid any surprises. Anyway, so all these numbers here obviously transfer over to the scenario tab, and all these numbers here transfer over to the unit mix tab. And the unit mix tab is where we start. You can see where the current annual revenue is at right there. And this is the gross potential revenue annually. And the difference between this number and that number is 8.6%, which is a loss to lease. So once you do all your calculations in the rent roll spreadsheet and the T12 spreadsheet, and you put it into the inputs, everything transfers over here to your spreadsheet because of the wonderful job Manny has done in programming this and making it more robust. So you have your T12 section here, where you have the asking price 21 million, which is 175 per door. You have the actual T12 income, vacancy, loss to lease, and everything all written over there, versus the T3 and T12 expenses, which is right here. And then you come over to your year 1 forecast. This is where we start doing our underwriting, where we put in our assumptions based on what the property manager comes back and tells us, or just based on our market data if you don't have a property manager yet to run things by. So these are the assumptions we had. The taxes, you always want to get a tax quote from the tax assessor, right? You run all these numbers by your property manager to see if they make sense, and the property manager comes back and gives you some feedback. For these, it says CP&L, so you're going to see that change in the P&L tab. And these guys were capturing about 91% of the water sewer bill, but we're going to run it at about 89.7% based on the feedback that we're getting from the property manager. And the debt quote we got on this one was 3.4%. It's a bridge debt. 3 + 1 + 1, 60 months IO. And it was like 23% down payment. So that was 77% LTC, loan to cost. So the total value add budget is 1.2 million. And this is the value add section. This is what it includes. It includes exterior upgrades, 297,000. So our property manager actually gave us like a detailed CapEx schedule. A detailed CapEx schedule, which is right here. So this we got from our property manager, and this is the importance of having like a good property management company that you work with. So we have two budgets here. We have the first budget, which is very aggressive, and like it's the one that the broker was talking about, that you got to do a new pool, do the new decks, making everything looking all nice, and was suggesting that you spend about $743,000 in the exterior and $800,000 in the interior. So total $1.5 million to get that the rent bump of $400. But our property manager, with his knowledge of this area and the fact that they had just sold another property that was across the street, came back to us and said, you know what? After he went back and toured the property, he said, no, I really know this area very well. I don't think we need to spend that much money. So this is where we need to be, right? So the exterior CapEx dropped significantly to 297 because most of it was like building a new pool, buying new pool furniture, all that stuff. Doing the Amazon package and all this stuff. We didn't need all of that based on where the market was at. It was growing. So this is something else that you could offer to the next owner to come and do to upgrade the property even more. But where the property is at right now, you just want to do what is necessary to increase the value, maybe $300, and then you're still able to make good returns for your investors. So our value add plan included all of that. But for the exterior, kind of when I typically try to go a little bit higher than what the property manager is quoting. As you can see, in his CapEx, his total exterior was like 297, but I added some other stuff on there just to have some cushion in the deal, because that's something that we always try to do, to have a little bit of cushion in case you run into any surprises. And the goal was to renovate 100% of the classic units in the 1 and 2 bedrooms. Let me just come here. So you renovate 100% of the classics for $285 rent bump at $10,000 a renovation. The partials, we're also going to upgrade it to the new standard, and $200 rent bump. That would cost about $5,000. And some of the 3 bedrooms were like $300 rent bump, and the partials were $220 rent bump. So average is like $249, and the average cost is like $741.21. And this is for a market where the delta between this property and the one that is a comp is about $441. So these numbers are really within line, are achievable. We didn't think it was very aggressive for this particular market, but you want to do your rent comparables and do your market research before you are able to project these numbers, and run it by your property manager to make sure that it is achievable. So once we put in these numbers, the other thing you want to look at is the exit strategy. If you're trying to refinance at a certain year, you want to change that here. Maybe refinance year 3 or something like that. Or, this one, our business plan was not to do any refi, just to hold for 5 years and sell. So you could play with that to change the refinance number as well. Other thing I'm going to point out is the going in cap rate on this is like 4.13. On a T12 basis, going in cap, T3 basis, going in cap rate is 3.02. And we have the exit cap rate at market cap rate at 4.5, exit at 5. And a lot of deals right now, you see some of them being projected exit cap rate significantly lower than what we have over here. Some of the operators actually project the exit cap rate to remain flat from where they started. Are they right? Most likely. Those markets, they can produce those kind of returns, but conservatively underwriting, we like to have 10 basis points for each year just to be conservative. And if you run now, even if the market is growing, it's always good to have that, because if you run into any surprises or anything goes wrong with that property that you did not plan, this is going to save your butt from having to go back to your investors and giving explanations of why you were unable to meet your projections significantly. So in the P&L tab, this is where we do a little bit more of the detailed underwriting. You see here we had the rent growth year one at 4%, which based on what is happening in this market is reasonable. You saw the broker said 6.4% annually over the next 5 years. But really what that is like year one is like 14%, year two is like 9%, then the other subsequent years is like 4 or something like that. So they kind of average it out and say 6.4% over 5 years. They kind of divide it. So I run these numbers by a PM, and if it says this is good, this is conservative, okay, then I'm happy with that. So 4% is good. In Atlanta, I've seen 5% year one and 5% year two. That's not being too aggressive in Atlanta and in certain sub-markets in Atlanta, because Atlanta is growing significantly. So and you come here, you bleed down the loss to lease because the property rent is increasing. By the time you get to the 1 year cycle of renewing all the leases, you should be able to get this number down at least more than half, or maybe most of it even off. So I try to do a half or a little bit around there, depending on what the market is and what the property manager is saying, and just bleed that down maybe to about 1% loss to lease. Vacancy will never go below 5%. Concessions, if it's at 1%, I'll keep it that way. I could go sometimes to 0.05 if the property manager says we're not going to do any concessions in this market. Bad debt started at 5, so dropped it down to 2. Property manager said don't go below 2% on this one because of this particular market. Some markets, they will say go down to 1. We'll do that as well. The other thing I want you to pay attention to is the taxes. We got a tax code for the property, and the taxes, there were 2 scenarios on this property. There's the best case scenario and the worst case scenario. The worst case scenario, the new taxes get assessed upon purchase. And in the best case scenario, the taxes get assessed the following year. Now, I want you guys to pay attention to the differences, right? How this can really affect your deal. This is worst case scenario. Summary tab, these are the returns on the worst case scenario at the current price, at that price of what is it, 152,000 per door. So worst case scenario taxes, you have 17% average annual returns. Now, if you were to get lucky and purchase this property and your tax consultant appeals and you get the best case scenario, which pushes your tax reassessment, oh, sorry, this thing's going too far, which pushes your tax reassessment to the second year of ownership. Now look at the difference in returns. So your returns jump to 20% from 17. Your cash on cash jumps to about 10%. So it looks much, much better if you're able to get the best case scenario. But again, it's better to underpromise and overdeliver than the reverse. So we typically go with the worst case scenario, and that's what we base our offer off of. If we go into the property and get a better scenario, that's fine. It's more money for investors and more cushion for us managing the deal. The other thing I want you to pay attention to is the water bill. One of our plans was to institute a water saving program. And once you do that, the water bill decreases to about $65,000. It drops by about $40,000. But when you do that, when you decrease the water bill, make sure you decrease the water income as well. Because if the water bill goes down, the water income is going to go down, and you can only get up to 95% of that water bill. So that's what this number is right here. The other thing you might do with the property over time is decrease marketing. After you have the property stabilized between year 1 and year 2, there might not be a need to be being very aggressive on marketing unless the market is not growing, then you want tenants in there. So in that case, you can drop your marketing budget by a small amount of money. On this spreadsheet, other things to pay attention to when you underwrite, pay attention to line 59. Members' preferred deficiency. As you can see on this property, the pref deficiency year 1 is $127,468. That's not too bad, right? You could literally make up for it in year 2, which is the case here, because year 2, the income goes up significantly. You're able to make up for that pref deficiency. But if you underwrite a property and on line 59 on this spreadsheet, you start having, let's say 300,000 here, 400, 200, 100, and maybe it's like year 5 where you don't have a pref deficiency. That's very risky because you're promising your investors a certain amount, and over the duration of your business plan, most of it, you're not meeting that amount. So if anything else goes wrong, that will put you in the red, and you're not going to be able to catch up to that pref deficiency. So ideally, you don't want to see the pref deficiency go past year 1 and year 2, or it should not be like a significantly high amount that you cannot cover. The other thing we do when we underwrite these properties is we build in a good amount of money in reserves. For this particular property, there was $275,000 in reserves. And on the acquisition cost side, you also want to have a little bit of cushion so you have more money in reserves in case you run into a scenario where you have some deficiencies, then you could use your reserves to make up for that. So you can spend some time here, play with the numbers to based on feedback from your property manager. The great thing about the spreadsheet here is you just got to change the percentages over time to reflect how better you're managing the property. And when you do that, you already went over your exit strategies, and you can come back and look at your summary to see like your average returns, what you're able to give your investors. Right now, these numbers look really good. It's not bad. And just another illustration, if we were to decrease the cap rate by 10 basis points, right? I want you to see how that affects the deal as well. So it goes up significantly. And if you're a passive investor, that's just one thing to pay attention to when you're being presented with deals. Just see where the exit cap rate is at, and based on the projections that they're making. So because changes in cap rate can significantly affect the value of a property. If this cap rate were to go up 10 basis points the other direction to 4.6, that means exit is 5.1. You see the returns drop from 17 to 15.8%. So these are just some of the things that you want to pay attention to when you're looking at properties. That said, for the syndicators or future syndicators on this call today, one of the sections that we don't talk about a lot is the return section. We haven't really gone over this in the call in the past, but in this section, if you have multiple partners, you could kind of break down how you want to split the deal, right? So you can see here you have partner 1, 2, 3, 4, 5, 6. Let's say, for example, you put a deal together. You are the main person, like your group. Let's just call your group UP or whatever. And so the deal is split. You see, there are different sections on the spreadsheet on how you could distribute the returns to each general partner. There's a GP percentage for sourcing, contract, due diligence, and closing. This is for looking for the deal, underwriting the deal, managing the due diligence, and closing the deal. So this usually goes to the person that finds the deal and brings the deal to the table, right? So we say our partner 1, UP, got 100% of that, right? Then there is the EMD money. For these deals right now, for example, on this deal, we put in $1 million EMD, with 500 going hard on day 1 of signing PSA. So you might find somebody to come up with that money, and in exchange for that, for them taking the risk and doing that, you can give them, maybe let's just say you give them 10% of the deal, right? So UP gets 0, then EMD gets 100% of this, right? Whoever you got for EMD got 100% of the value of the GP on that. And then money raiser, of course, let's say if you as the main person, if you raise some of the funds, if you have other partners that come with the funds, for example, let's say each partner brings in $1 million, right? 1, 2, 3. 1, 2, 3. So you have 3 other partners and each person brings in $1 million. So that $1 million goes into the split of the money raiser part of the GP, right? So they're gonna end up with about 18% of the split and about this much of the GP. And then balance sheet guarantor, this is like your KP. If you have somebody that is KP and is not you are not balance sheet guarantor and somebody else takes that deal, you decrease that. The KP gets 100%. Let's say you give them 20. At the end of the day, you want all these numbers to add up to 100%. So looks like we are short 5%. Anyway. So it looks like we're short 5% here. This is 100. I'm just going to change it to 20%, see if that works. Yeah, so this is 100, but some part of this is missing. Somebody needs. You guys see what I'm missing somewhere? Anyway, this is just for demonstration purposes, but this should add up all to 100%. And I'm short here, and this should be about 20%, which is 100% of the GP. And when you come up here, after you split that up, you have the exact amounts of what everybody gets. You as the main person, UP, this is what you get from the acquisition fee. The second partner gets this, partner 3 gets this, partner 4 gets this, partner 5 gets this, right? And same thing with like distributions over years. And once the deal is sold at the end, this is the total that goes to the managers, and this is how that is split out. So that's one great thing about this spreadsheet is that it helps you determine how you're going to split your deal or distribute your deal amongst you and your partners. So is this another feature that you want to take make use of and take advantage of? And you could kind of change the titles of whoever is receiving what, however way you see fit. And that's it. Going over this deal. Anybody, questions time?
Nothing about this particular deal, but I was looking at your this sheet, the underwriting sheet, and I see that when you go to, I think it's a summary tab.
Yeah.
And if you go to the bottom, let me just check if it's just summary, just bear with me a second. Where's your lender hold?
Oh, you mean like this one?
Acquisition.
That's it, exactly, the bottom, right bottom, this lender hold. So when you factor in this lender held funds, I see that you put them in your value add. So when you go into your value add, I see that amount, because you've escrowed these amounts, but how are they returned to the investors? Because when I look at your sheet, I can't see that return back in the sheet.
So you mean like these lender held amounts here?
Yeah.
Oh, that's a good point. Yeah, this is escrowed year 1. This just goes back into reserves and ends up being like some kind of a cushion at the end of the deal. Typically don't underwrite it being returned. We haven't done that in the past, but that's a good point.
Because I see that lender held funds there, and then if you go into your value add tab, I think if you go right to the top, it's there. So if you look at the top, lender held reserves to be returned 89,000. But then I don't see that in the P&L or anywhere, or in the return.
It doesn't get, it goes into your
Returns,
CapEx reserves. You just use it as a cushion. Similar to like how you budget like 250 per unit for reserves, but don't factor return in that. So if you do returning at the end, then it's just like bonus to your investors.
Okay,
So it
cool.
just goes back into the CapEx pool.
Got it.
Because I think initially we're trying to figure a way how we can maybe get it. This was like during the pandemic and returning in year 2. But the problem is that when you add that to your return, it incorrectly inflates the returns.
Yeah.
Okay, got it.
Because it's not operational per se.
So Leslie, Johannes here.
Yeah.
Question on the expense escalator. I think you had 2% there. So with the inflation running at 5, how do you come at 2?
Yeah, this needs to be adjusted. Based on the feedback that we get from the property manager, that's where they left it at 2. But this probably needs to be adjusted based on what's happening in the market right now.
Gotcha. Okay, thank you.
Let me see what happens if that goes to 5%. It doesn't kill the deal per se, so.
Let's see, I think you adjusted the income escalator and not the...
Oh, no, not the expense, sorry. Expense escalator. Yeah, it affects the deal significantly. So that's a very good point that we all need to pay attention to, and run these changes by our property management team. Because one of the things we do is we already do right now is underwrite the increase in cost for everything. For example, payroll has gone up significantly. Like even what we budget for marketing is kind of higher than what it was done about a year ago. What else? So there are a couple of other things that our property management team came back to us and said, you know what, like the value add, even the value add cost is significantly higher than what it was before. That the PM team came back to us and say, you know what, prices are kind of high right now. This is where you need to put it. So, and sometimes these numbers get factored in different places, but it's good to show it up here that it's escalating over time. So, thanks, Johannes. That's a good catch there. I hope I did not put everybody to sleep because everybody's quiet.
Hey, Leslie, I had a quick question. So basically you work on these numbers, like, maintenance and all that stuff and value add and all these numbers that you get to input into this analysis. You work with the PM pretty closely with some of these things in a different market, or how does that work?
Yes. We work very closely with the property management team. From the moment we get a property, we send it over to our property manager and see if it's in a good area or what their thoughts are about it. If they say it's a go, then we're going to do a preliminary underwriting like this and send it over to them. They'll take a look at it and come back and say, oh, this number is off, this is off, or you need to go up on this, you need to go down on this. Then we'll make the adjustments accordingly, and then send it out to the lender and say, this is where we at. Can we get a debt quote? And they'll send us quotes. We make adjustments as well. And again, just keep making adjustments as we go. When you go visit the property, do due diligence, you come back and make more adjustments based on what you see. And at the end, if it makes sense altogether, you go for it.
Okay. Sounds good. Thanks.
Yeah.
Yeah, Leslie, let me ask you a question. Your T3, what was the NOI on your T3?
63,000, 633,985.
633.
Yeah.
Okay, 633. Now, I'm say 985 now. Based on that number right there, that NOI right there, what is the value of the property based on that number? I think you said the cap was 4.5 or something.
The cap rate 3.02. At 3.02 is like 21%. At 4.5 is 14 million.
Okay, so it's worth
But
around.
that cap rate of 4.5 is the market cap rate, is not the property cap rate. So
Okay, the market. Okay,
yes, there's a difference, especially right now. You use the market cap rate to determine what your cap rate will be on exit when you have held the property for 5 years. So with a lot of properties right now, especially the value add, the cap rates are really low. Some of them are below 4, in the 3s, like you see right here. And even before this craziness that's going on, you could still buy a value add deal for like a 3 cap, because there's a lot of value, there's a lot of meat on that property, where after you finish all your renovations and increase the income significantly, it should be able to perform very well if you sold 5 basis points above the market cap rate. So the property cap, the going-in cap, if you were to buy the property at full price, is 3.02%. But you want to project based on the market cap. Exit cap rate should be 50 basis point above entry.
Okay, so you just said, correct me if I'm wrong. So at the 3.0, you use my 21, but then you should go look at X at 3.5.
No, you make your offer based on not necessarily the cap rate, but based on the returns that you're gonna get. For example, the offer we made was about 18.350, right? Which if you use that amount, the going in cap rate on the property is 4.13. So, but our exit cap rate is based on where we thought the market is, average market is at that point in time, which is 4.5, and we say we're going to exit at 5. If we put it at where we enter at 4.13, the property looks even much better.
Okay, now let me ask you, so this number here, 18, does it include the increase in the NOI based on your value adds?
Yeah, this number it encompasses everything. You don't, James, you keep going back to making offers based on cap rate and cap rate calculation on the valuation of the property. I think that's a direct cap method. When you're doing like a syndicated deal or like value add deal, it's tough to offer based off of that, right? Because you're looking at the straight value, but we making an offer based on the projected income that this property is able to produce over a period of time.
Yeah. Okay, here's the reason I asked that. question. Now, I listened to Grant Cardone. Okay, what he usually do is he look at the income that the property is generating when he take title to it, get the contract. Okay, and then what he says, okay, now if I raise the rent $300 per unit, time the number of units, time 12, and then the value would go up $12 million, or whatever the case may be. So that's what I was heading towards. So what I'm saying is that based on the way he talks most of the time, he's saying that the NOI say is $300,000 as an example. But then when you do all your value adds and things like that at $300 per unit or whatever, the value goes up, the income, the NOI goes up to $400,000 or whatever. Then you take that $400,000 and say, okay, based on that 3.5 or whatever cap rate is, the value then would turn into, you make an additional $12 million or whatever the numbers are. Then based on those numbers there, he would make a offer. Does that make sense? Does anything I just said make sense?
It makes sense. Essentially, what he's saying is what the spreadsheet does.
Okay.
Yeah, he's just trying to explain it in a way that that is simple, simple for anybody to understand. But that's essentially what the spreadsheet does. He talks about the income part. He does not mention the expense part as well, because that's one thing you got to be mindful of. That's one thing you got to be careful, especially when you listen to us syndicators talk about properties. It's always, the income is always good, but you always got to look at the expense as well. Although a lot of times the expense does not change significantly when you increase the income, but you got to calculate all of that, put all of that together to be able to come up with the value, and which is exactly what this spreadsheet does. So that's essentially what he was explaining. I don't know if anybody has any other input to add to James's question. Manny, do you have anything?
I had a
What was
question.
the question?
To James's question about the using the direct cap method.
It's essentially what you said. What Grant Cardone is doing is the same thing, because you're still calculating the NOI and then determining how much of that is increasing the value per year. With the discount cash flow method, which is what a lot of the syndicators use, you're using the cash flow, right? So you're focusing on the cash flow and you discount that back. So if your plan is to sell in 5 years, right, you estimate or you forecast the cash flow for the next 5 years. And then based on those cash flows, you discount it back, right? And the discount rate is usually like your cap rate or your inflation rate. Discount that back to get what the true value of the property is. With a direct cap method is just a snapshot in time where you're saying that, okay, this property is producing an NOI of say $2 million. I have this cap rate, which cap rate is just a sentiment of the market, right? It's really like a useless metric. It's just a sentiment of the market. I have this cap rate of 4%. What is the estimate of this property at this point in time? But it doesn't forecast what your value add is, what there's going to be changes in your expenses for the future, right? To do that, you have to forecast your cash flow and then discount that back. So there's two methods of doing it. So what you're referring to is just a direct cap method. Does that make sense?
Yeah, but I thought he said something about, does that affect the price, the offering price, like based on the forecast? Does that go into what you're going to offer? Is that what you said, James? Because that's what I thought I heard.
Yeah, so catch it like that. So okay, so in order to capture $7 million, you're gonna have to spend $1 million in CapEx. So you still got $6 million to play around with. So the reason I'm asking this question here, could you offer more money doing it that way? I'm just trying to figure out how you can offer more money. You know what I'm saying? If you just say, okay, based on the NOI, based on 5 years, the value gonna go up so much. You're gonna spend 1.5 million to CapEx and everything like that. You subtract the CapEx from the total amount that you're gonna make, and then back it up and say, okay, instead of offering 18 million, we can actually offer 21 million.
I mean, it's based on your returns, though. It's all driven by your cash flow, right? Your NOI, right? Because essentially what you're doing, you're trying to forecast what that cash flow is. So if you forecast a higher cash flow, then you can discount that back to a higher value, right? If you say, if I put in X amounts into value add, I'm gonna get in Y amounts of cash flow, right? So if you adjust that metrics, say if you budget 10,000 per unit, you get 250 per unit for one scenario, your cash flow is gonna be higher, right? And all that cash flow or your revenue is gonna increase your NOI, right? And if your NOI goes up, then your value of the property goes up as well. So there is a direct correlation. So you can estimate it. So if you forecast that the cash flow is going to be higher in the future, right, that drives what you're paying for that property now.
Okay.
But the cap rate is also very important, right? Because if you increase your NOI by $1 and your cap rate, your estimated exit cap is 4, then that $1 is going to increase $25 the value. But if you have a 10 cap and a mom and pop mobile home park, that $1 is only going to get you $10 in the end. So
Right.
you really know both the NOI and make some kind of an educated guess about the exit cap, right?
Right. So that's why it's kind of important to use like the market cap rate versus like the property cap rate, right? Because the cap rate is just a value used to, it's a metric used to value like multifamily units, right? So if you use a property cap rate, for example, if you have a bunch of like 100 units properties and the market cap rate is say 5%, but the property you bought, even though they're all comms, is at a 3%, right? So you're paying much higher for that property on entry. But on when you're going to sell that property, right, the buyers are going to be looking at the market cap rate because they're looking at the comps, right? So the cap rate is very important in that sense because it's a way for you to gauge what that property is valued compared to the other units and the other buildings in the area.
But you know,
So it is important because you do need that to get the value of the property.
And to your honest point, that is very crucial because, for example, with the value add, the entry cap rate is usually most of the times usually lower than the market, right? And if you project your exit based on the entry, the property might be overvalued. The price might be overvalued. So, and then that's why Manny is specifying that you want to project your exit based on the market, not on the actual going in. In some rare cases, you might buy a property that is higher than the market cap rate. And when you get that, you got a sweet deal.
that's what I'm getting to. Yeah, you're supposed to buy, right? You're not supposed to buy at market rate. You're supposed to buy higher than market rate, right?
Right. So I stand correct. Yes. So if you are getting it at a higher cap rate than the market, that works in your favor.
Right.
So you do want to take that.
That's very hard to do, right, in a value add, because in a value add, you typically buy something that needs a lot of work, right? So
right, you wouldn't.
So
that's why Leslie's saying if you find that, that's like a gem because that's
when you're good to go, right? So.
Right, because you're buying building equity already. So you just.
I saw in some mobile home parks that there's an interesting model where people buy these like really small parks that tend to have like really crazy cap rates because they're very risky and poorly managed and everything. And then they turn them into big portfolios and sell them into much bigger buyers. And sometimes they can go from 10 cap to 6 cap from entry to exit. And then they just make, amazing amounts of money.
That's smart. That's a very, very smart strategy right there. Wow.
Yeah. And it kind of shows you how easy you can manipulate the cap rate and the value of a property, right? Because it's still the same property, same income, or right, compared to the comps. So it's, yeah.
Any other questions, guys?
I had a question about the property manager when you said you went to Atlanta. You basically, did you have a relationship with the property management company prior to looking at the apartment complex, or did you just make that once you decided to look into it?
No, we've been building you got to start building relationships with a property management company way ahead. We've been building our relationships with this property management company for a very long time. And they manage our deal in Colombia, manage the other deal in South Bend, Indiana. So it's a long relationship that we've had with them. So yeah. So prior to going over there, we had that communication.
Did they cover Texas?
Did they go to Texas? I think so. I think they manage some properties in Texas. I could ask the VP just to be sure.
It'd be interesting because I like what he's done with the breakdown. I work with a few property managers. They don't give us a breakdown like that.
Yeah, he just did not do a breakdown. Because this was so competitive. The owners wanted us to drive a business plan and write everything else before we went to best and final. And he wrote something, sent it over to us. We adjusted it. So very great. This is a very good property management company. I'll ask them if they go to Texas, then I'll pass the information over to you. By the way, ask about a debt, about a lender. Let me just paste Amit's number on here. He's with JL Capital. If you guys are interested in finding a debt broker, this is someone that you can reach out to. Just let him know that that I referred you, that Leslie with XSITE Capital referred you guys. So yeah, he's very good. He gives some debt options. Yeah.
Do you look KP? Do you ever get in KP positions?
You said, do I have a KP?
No, do you become KPs on deals?
Not yet. Not yet. Not yet there, Dal. Get in there.
I've got a property I'm going in on in Houston right now. It's about 12.2, 120 units. 12.2 in Houston.
Okay.
120 units. It's quite a sweet deal. It's 100K a deal.
That sounds like
yeah. So we're just putting that offer in today, but we'd love to get some KPs on there because we need that balance sheet covered.
Okay. I'll shoot you my address and this is my email address. Send me an email. I'm gonna introduce you to a couple people.
That sounds good. Thank you, man.
All right, you're welcome, brother. All right, guys. Any other questions before we wrap it up? And by the way, Dow has a spectacular day in Houston. So if any of you has a balance sheet of $12 million and wants to get a good piece, please reach out to him.
Manny's gonna bring the 12 million. I can see it. He's ready for it.
You see, Manny came on camera when I said 12 million, right?
Exactly. You came on camera thinking, yeah, I'll bring that 12 million.
So he might be a KP for the deal, man.
I came on to say goodnight, man.
All right, guys.
All right, guys. Great session. I'm going to try to build a calendar of the classes month by month with links for everybody to go in and review documents for days that we got to review a deal for somebody to present. So I just came up with that idea this evening while we're talking. So I'll put something together, then I'll let you guys know.
All right, cool.
All right, guys. Good night.
Good night.